So hello, my colleagues, and I hope everyone is well. So I want to talk a little bit about the four key financial statements, and they differ from book to book. What people consider the four statements, but I want to talk about the income statement, the balance sheet, the statement of stockholders' equity, and the statement of cash flows. Okay. They all tell you a lot of they all contain a lot of information, and they use this Bartlett company here to carry throughout the chapter. I think they're an imaginary company, but they use them to illustrate a lot of points. And you'll probably see these in an accounting class. Okay, so the income statement. Let's talk about that a little bit. So that provides a financial summary of the firm's operating results during a specified period, usually 1 quarter or 1 year. Companies produce and release to the public quarterly and annual income statements based on their fiscal year. Now, their fiscal year could be different than the actual year, right? So you always got to find out what they consider their fiscal year, which may or may not align with a calendar year. Okay, so and then talk about Kroger here, right? All right. So I'm not going to talk about ethics because you could learn about this on. You probably have to take a class in ethics at Stony Brook anyway. All right. So and there's a couple different little blurbs here about a company called Logitech and. All right. So here's a simplified income statement for this company called Bartlett, whoever they may be, real or imaginary. So you'll notice here on the very top is the sales revenue. And they do it for 2 years here, right? Sales revenue is, what you're selling, right? The product you're selling. And here's the cost of goods sold, what it costs to make it, right? And you subtract these two, and you get a number called the gross profits, right? The gross profits is, so you can see if I subtract these two, I'll get this number here, okay? So just want to make that clear. And then you got your operating expenses for the company. You've got operating expenses such as selling, and they list all these operating expenses here. And depreciation is an important term. Depreciation basically means assets you have, physical assets you write down as they age and they get older. Okay. And the next one we have here is basically you add up all your total operating expenses. So if you add up these expenses, you should get this number right here. And when you subtract that from the gross profits, you get what's called operating profits. Okay? You'll get operating profits. Now, it says here less interest expense, and let me be clear about what that is. If you have bondholders, people you borrowed money from, you owe them interest on the bonds. Okay? You owe them interest on the bonds. So you're allowed to write off the interest you got to pay, the coupons you pay every 6 months to the bondholders. Okay? So here they are writing off the interest, and the reason they do that, as you can see, is it'll lower their operating profits, and basically they pay less taxes. So here's the operating profits, and here they are subtracting off the interest. And so here's their net profit before taxes. Here they are subtracting off now their taxes, right? They got to pay taxes. And here's what's called net profit after taxes. So this is the net profit after taxes. And then they got to give dividends to the preferred stockholders before they give them to the common stockholders, right? So you got preferred stock dividends who get paid first. They have priority. And then whatever's left, earnings, this is either called earned income or earnings available for the common stockholders. Okay? So that's the very bottom. So we went from the top to the bottom briefly, and you can go over that in more detail. So here's the earnings per share. This depends on the number of outstanding shares in the market, right? And here's the dividends per share. Some companies will pay dividends, some companies will not. I own stocks that pay dividends. Some companies do not own stocks like Google. I own Google, but it doesn't pay dividends because they use it to grow the company. Neither does Amazon.com. Okay, so they go through everything I kind of went through here, and they talk about net profits or earnings on the very bottom, right? Also referred to as net income. So there's a couple words for the bottom. All right, and then basically here we are subtracting the preferred stock dividends. So we got a couple more things on the bottom, and from net profit after taxes, which is right here, we arrive at earnings available for common stockholders. All right, so these are the last three items. Okay, so all right, so I just wanted to show you that. Companies are not legally, and here we are, not legally required to pay dividends to shareholders, and in fact, many firms do not pay dividends, preferring to reinvest their earnings in new assets to finance growth. So it depends on when you buy a stock, you have to find out. Okay. All right. So here's a nice personal finance example of everything we just talked about. So you can go over this, and finance is important from a personal standpoint. You yourself are a company, right? So, all right. So now the next statement we want to talk about is the balance sheet, and that presents a summary statement of the financial position at a given time. And basically, what that gives you is assets and liabilities. So here they are. Here's the of Bartlett Company's balance sheet, and they have it for 2 years. As you can see, they're showing it to you for 2 years. And the important thing is the balance sheet has got two major sections here. They have assets and they have liabilities. So here's the assets, all right? And if we scroll down, and if we scroll down, here is our liabilities and stockholders' equity. So it's divided into two sections, right? Here's the total assets. So let me highlight that. And here is the liabilities and stockholders' equity section. Now you'll notice they have the short-term current assets first. And that's the total current assets. And if you look carefully, you'll notice it's the most liquid stuff: cash, marketable securities, accounts receivable. Accounts receivable is money that is owed you by the people who haven't paid you yet. Okay, so that's called accounts receivable. And of course, you have inventory. And inventory comes in three components: raw material, semi-completed products, and completed inventory. So you'll see that in three different formats many times. All right, so liabilities, again, you have short-term stuff up here, and you'll notice it says total current liabilities, which are short-term liabilities. So we have accounts payable, notes payable, and we have accruals that have to be paid, wages and rents and all that stuff. I believe I sent you a Merrill Lynch document on, Right, and then we have long-term debt. Right, here's the long-term, which are bonds. All right, so you got total current liabilities, and then you have total liabilities, which is the sum of the long-term and the short-term. If you add up these two items, you should get this guy right here, okay, for the year up here. Now we have the stock, right? We have preferred stock. Okay, now we're doing the stockholders' equity. And stock at par this is given $100 par value. Okay, a lot of times the stock this is a fictitious number, like for common stock. It's a number they just dream up. So that's for that. Okay, so you got the preferred stock here, right? And you have the common stock here. Okay, so we have the common stock, and they tell you, the par value, which is again fake, and the shares authorized and shares issued and outstanding. So here's the shares outstanding for both years, 2018 and 19. And here's the paid in capital in excess of par, and that's the value as the stock went up, okay, above the par value. That's an important term. Okay, and then any retained earnings that haven't been paid out in dividends that the company has kept, which technically belongs to the shareholders, goes there. So here's your total stockholders' equity. And total stockholders' equity is the sum of this, and this. So if we add up these four numbers right here, we should get 1,954. So if we take that and the total liabilities right here and total stockholders' equity, you should get a total liabilities and stockholders' equity number, a grand total of that number right there. And I don't know what that's all about, but I shouldn't have done. Maybe I shouldn't have done that. All right, now I can't get rid of it, and you'll notice that this has to equal the total assets. So that's why they call it a balance sheet. Okay. All right, so they make a clear distinction again between short-term and long-term assets and liabilities, and you could read this, kind of goes into what I said. All right. So they list everything that I talked about. Retained earnings represents the cumulative total of all earnings net of dividends that the company has retained and reinvested in the firm since its inception, right? They're not paying out any dividends. All right, so paid in capital in excess of par. This amount of proceeds in excess of the par value received from the original sale of common stock. All right, so again, here's a nice personal finance example. All right, so we'll pick up with the statement of retained earnings in the next video.